Hi guys, welcome back. Now in this video we're going to be discussing the short term and the long term impacts for an economy who's deciding or is investing more in capital goods instead of consumer goods, because oftentimes economies do face this trade-off that whether they should invest or produce more consumer or capital goods. And such questions were also tested in your past papers as well. So I've taken two such questions. I don't exactly remember which year was the first question from, but it says explain with the help of a PPC diagram how a decision to reallocate to produce more capital and fewer consumer goods would affect consumers, right? And then it says and consider whether this can increase consumption in the long run. But again, ideally it is asking you to tell you about what impact will it have on the consumers in the short run. But then it's not necessary that they only ask you about the impact on consumers. They could generally ask you about what impact will it have if we invest more, reallocate more on capital goods. The second question was from specimen 23, which says explain how a PPC can be used to show the concept of opportunity cost, and then consider whether opportunity cost is likely to remain constant if more is reallocated. Anyways, so this is not entirely asking you about consumer and capital goods, but in fact there was another question as well that was asking about whether if we invest more in capital goods, then what will be the short term impact, and then they were asking about the long term impact. So this video is primarily focusing on the short term impacts and the long term impacts of an economy that is focusing more on capital goods. So ideally if you can see that obviously at the start you will be defining what a production possibility curve is, and what does it shows? It shows trade-offs. Societies make trade-offs. Yes, it shows choices that could be made. It reflects scarcity, and then societies need to make a choice, and they need to make a trade-off. But then anyway, so primarily my focus right now is to tell you the difference between the short-term and the long-term impacts. And so if you'll draw a PPC and you say that, if the economy moves from point A to point B and it is investing more in capital goods, which means that fewer consumer goods will be made. So the impact that you would be mentioning, the immediate impact, the short-term impact that an economy will have is that it is going to be foregoing consumer goods. But obviously you just can't just say that it is going to be foregoing consumer goods, right? You need to talk about it, and then you'll say that, for instance, you'll say that capital goods like infrastructure and machinery. The thing is that capital goods do not directly satisfy consumer wants, right? Therefore, the more resources are devoted to producing capital goods, the fewer resources will be available to producing consumer goods, right? Which means that yes, consumer goods there would be a decrease in production and consumption of consumer goods in the economy, across the economy. And so this is the opportunity cost in the short term. And so the opportunity cost would be the immediate satisfaction that consumers need to give up, because consumer goods results in higher consumer satisfaction. So consumers would give up the immediate satisfaction, right, as the production of consumer goods decreases. And then you won't stop here. You'll say that this can lead to reduced consumption, and then it can lead to lower living standards across the economy, and it could also result in potential discontent. And the correct word is political and social discontent, right? It could result because of fewer consumer goods being made. So yes, and if you make drastic changes across the economy, let's say you directly jump from point A, let's say if point B was somewhere over here, and you invest a lot in capital goods, which means that you suddenly decrease your production of consumer goods from, let's say, 10 to somewhere over 1, then obviously this will have a huge level of political and social discontent in the economy, because people will be like, consumer goods satisfy consumer wants, so the fewer they are, the more discontent people are, and the more lower the living standards, and so the welfare will be compromised and sacrificed, right? So yes, this will lead to lower consumption of and lower living standards, and like I said, it will lead to potential political and social discontent. But obviously in the short run or the short term, because the thing is that what you need to write is that it is beneficial to invest in capital goods, but the thing is that the benefits of capital goods investment is not immediately visible. This line you have to write in the exam, that the benefits of the capital goods investment will not be immediately visible. And so the second short-term impact that will happen is that it may result in, since in the short term the focus is entirely on capital goods, it may result in slower economic growth in terms of, current output foregone. Because what you can say is that if the economy is investing and focusing more on capital goods and fewer consumer goods are being made, so it will slow down the economic growth. Why? I'll explain why. Because you see, since consumer goods satisfy your current demand, right? Consumer goods are those goods that satisfy current consumer demand. And so since consumer goods satisfy current demand, and producing fewer of them for consumption will result in lower consumption expenditure, which will result in lower GDP in the present, right? In the present moment. So, but the thing is that in the long term, economic growth will rise, but in the short term, it may be slowed. Instead of saying it will decrease, you can say that it will slow down the economic growth, right? But the thing is that, however, we know that economy is investing in the future. The thing is that if the economy is making capital goods, you can write this down that it is investing in the future. So these are the key terms that impresses an examiner. So it is investing in the future, and what this means is that these capital goods will eventually increase the economy's productive capacity, and in the long run the PPC will shift outwards, and we'll see that in the long term impact. So but the thing is that this benefit of a rise in productive capacity and potential in long-term economic growth and potential economic growth, this benefit is deferred. You don't see this benefit immediately in the short term. And so what really happens is that since this benefit is deferred, it causes potential short-term contraction. Especially, there's a short-term, you can say there's a short-term contraction, especially in those sectors of the economy that are consumption based. So the short-term contraction in the consumption based sectors of the economy, right? Consumption based sectors of the economy, that there would be a short-term contraction which will slow down growth in the economy, right? And then obviously you will show this by a movement along the production possibility curve, that if you produce more capital goods and less consumer goods are being made. So this is just a modeling of the trade-off that you are showing, that if you increase the capital goods, consumer goods less are made. So this is just a trade-off. It's just a choice that society is taking, right? So the thing is that it's just showing that there's a movement along the curve. And so in the short run, there would be no shift in PPC, right? In the short run, the PPC does not shift outwards or something like that. Because the reason is that the economy's resources, land, labor, and capital, we know that the economy's resources are fixed, right? And we are just reallocating these resources towards more capital goods production, which simply means a direct reduction in the consumer goods being made. So this is the opportunity cost, and the fact that living standards are compromised is also the opportunity cost, and the fact that there would be a contraction in the economy, especially in the consumption-based sectors of the economy. Again, this is an opportunity cost as well, right? So, and so the thing is that you could also say that there would be in the short term, these are all short-term impacts, and you could also say that in the short term, there may be unemployment or underemployment, because industries that produce consumer goods, right, those industries that produce the consumer goods, that industry will shrink and decline and contract, right? The good words that you can use are contract and shrink. And so it will result in structural unemployment. This is a sort of type of unemployment you will study later on in your AS unemployment chapter as well. That this sort of unemployment occurs when there's a structural shift in the industry, or when your industry declines, basically. So structural unemployment can arise because workers in the consumer goods industries, they may not immediately find employment in the capital goods sectors, right? Maybe because that labor and those resources are not that mobile, right? Maybe they are quite immobile, right? And so since they, and the more immobile the resources are, the longer on the, or the prolonged would be the structural unemployment, right? And maybe training and upskilling may be required for labor to transition to, capital goods industries, which could probably lead to temporary inefficiencies, right? So yes, all of these impacts you have to mention in an 8-mark answer, right? All of these impacts you have to mention in an 8-mark answer. And there was this question which I haven't really mentioned here. In fact, this question is not that relevant. It was the other question that said that if the economy is producing more capital goods, then what will be the short-term impact and the long-term impact, right? So all of these impacts that I have mentioned are the short-term impacts. And the mistake students make is here, that they say that the short-term impact would be that less consumer goods will you make, and they correctly show it on the PPC. But you are sitting in an A-level exam and an advanced level exam, and you can't just write only such little stuff saying that less consumer goods will be made. Okay, an advanced level paper requires advanced level thinking and advanced level methodology, so you have to mention all of these impacts that I just told you guys. Right now, guys, in the exam you will be asked to also mention the long-term impacts. So after the short-term impacts, we also need to learn the long-term impacts of investing more in capital goods, right? And so the long-term impacts, basically what you need to write is that you will say that in the long term what will happen is that the decision to, obviously you're investing more in capital goods, so it will lead to some major, or you can say significant, economic transformation. So use the word, you can say it will lead to significant economic transformations, right? And so these transformations will definitely have a very beneficial impact, because although in the short run we found out that there are some opportunity costs that the economy has to go through in terms of declining living standards and probably slow down in the growth of the industries that produce consumer goods and all. But in the long term, it is causing some economic transformations. For example, first of all, you will say that it will lead to higher economic growth in the long run. And such economic growth is basically known as potential growth. That is, it will cause potential growth, because investing in capital goods will enhance the productive capacity of the economy, right? So whenever productive capacity goes up, whenever your productive capacity of the economy would go up, it will cause potential growth in the economy. Because capital goods such as factories, machines, and technology definitely end up improving the labor productivity. Not only they improve the labor productivity, but they also improve the efficiency of the business. So they not only enhance labor productivity, but they also enhance business efficiency. And as a result, that results into more goods and services being produced with the same amount of resources, right? So it's causing the economy to be more efficient productively. So when you say that the productive capacity is going up, you need to explain why is it going up, right? And so as a result, what will happen is that because of this, the economy's PPC curve will shift outwards, and so you will make a new PPC curve saying that it is basically going to cause the economy's productive capacity to go up, and your production possibility curve will basically shift outwards to the right. You can label PPC1 and PPC2, right? And so label this as PPC1, PPC2, and then just label the axis as consumer capital goods. So this will be consumer goods, and this will be your capital goods, and this is your PPC1, PPC2. Okay, so and as a result, more of both goods will be made, right? In the long run, more consumer goods will be made as well, and more capital goods will be made as well. Overall, basically, you can say that when your productive capacity goes up, it enhances the capability of the economy to produce more output, because like I said, your business efficiency is going up, your labor productivity is going up, and your overall productive efficiency across or throughout the economy is going up, which is causing more goods and services being produced with the same amount of resources, right? And so your PPC shifting outwards over time, which is representing economic growth, which is also known as long run growth or potential growth in the economy. And as a result, the economy is producing more consumer and capital goods due to enhanced productivity, due to more innovation and technological improvements, right? So your overall potential is increasing. And the second point that you can also write is that you should in fact write is that it is going to cause an increased living standards over time, because in the short run you were saying that living standards will fall, but in the long run, over time the benefits of capital investment will become apparent, in the economy or throughout the economy, because increased productivity, when your labor productivity is going up, you see technological advancement, because when you say that you're investing more in capital goods, automatically it covers technology as well. So technological advancement will increase labor productivity and business efficiency, and when your labor productivity and business efficiency goes up, automatically it will lead to higher wages of workers across the economy, right? And demand for labor goes up, and because of that, demand for labor goes up, and automatically, since labor demand is derived demand, you're producing more output, so you're demanding more workers as well. And so because of higher labor productivity, it leads to higher wages across the economy. And that also, and at the same time, since your productivity is going up, although your wages are going up, but since your productivity is going up, and we're assuming that the productivity is going up by a much more larger extent, so it actually reduces the production cost across the economy. Because don't just think that your wages are going up so your production cost is increasing. No, since your labor productivity is going up as well, so your production cost is not increasing. It can actually decrease. If the labor productivity goes up by a much larger extent, it will lead to a reduction in production costs, right? And so since your production costs will go down, the firms will pass on that lower production cost to consumers in the form of lower prices, and that will result in a more affordable goods and services across the economy, which will actually improve standard of living as more resources, since more goods and services become available for people. And not only that, it improves the living standard as well as more resources become available, for the production of consumer goods, which is actually satisfying our consumption. It is now satisfying, as a result. What's happening here is basically that more consumer goods are being available and consumed by people, which is improving living standards, and also more goods are becoming affordable in that context. So in the long run, in the long term, what is going to happen is that the initial opportunity cost that we had faced in the short term, which was reduced consumer goods being made, that in the long term will be offset by the ability of the economy to produce both types of good. Because now, since the productive potential of the economy has gone up, the economy can produce more consumer and capital goods now. So that initial opportunity cost of reduced consumer goods is now offset by the increased ability of the economy to produce both types of goods now. And so economies that invest in capital goods, guys, will always experience higher economic growth in the long run, which will actually support higher consumption levels in the future. And as a result, it will satisfy future consumption and higher living standards in the future. Basically, that's what you need to write. Okay, this is basically the long-term impact, right? And so the third thing that you can talk about is, you can talk about, job creation. And in fact, before job creation, I think we can also talk about, I missed this point, that you can actually talk about technological advancement and innovation. And you could say that investment in capital goods will lead to technological advancement and innovation, because what's happening is that capital goods, especially modern equipment being used in infrastructure, modern equipment and modern infrastructure, will automatically embody new technologies that will improve production processes, and it will create more efficient methods of production. And as a result, this will benefit the economy over the long term. So the thing is that if the economy does not invest in capital goods, it will face a significant opportunity cost in the long run, because it would face an economy that will stagnate with reduced innovation and a decline in competitiveness on a global stage. Because if the economy is not going to invest in capital goods right now, it will face a stagnating economy in the long run. Because ultimately, like I said, in the long run, your business efficiency and productive efficiency across the economy will go up, and you'll face major economies of scale across the economy, and your average cost will decline, and so your goods will become competitive. it will become competitive in the export markets as well. So, and if you do not do that, ultimately your equipment and your machinery will be outdated, and there will be significant wear and tear, and it will need replacement, and you need to invest. It's not only you need to invest in your economy's capital assets, and you need your economy to grow over time, and for that you need to invest in capital goods. Otherwise you will face a stagnating economy in the long run, with very low levels of innovation in the long run, and ultimately it will decline your competitive edge in your export markets on a global stage. And for an economy that is a developing country, let's say for a economy that is a developing country, this might be very unhealthy. This might have significant macroeconomic impacts, negative macroeconomic impacts across the economy, right? And so no economy would want that to happen, right? And so another thing that you could talk about is you could talk about job creation, and so you see, in the long run what will happen is that, like I said, we do agree that yes, there will be some sort of structural unemployment in the short term, but in the long term, like I said, the increase in capital good production will ultimately create new industries and new sectors across the economy. Especially you could talk about there would be more jobs being created in high tech sectors like manufacturing, let's say construction or engineering, which will ultimately lead to job creation in new sectors, and it will lead to new employment opportunities, right? It will lead to new employment opportunities. And so, okay, fine, we agree that yes, in the short term some problem might be faced and there might be temporary unemployment, but ultimately your labor will adapt, and so the skills of the labor force may and will ultimately adapt over time, and ultimately this will lead to higher skilled and better paid jobs, because ultimately when you make that structural change, when you create high tech sectors which will ultimately pay you well, and you create those new employment opportunities, then your labor force and the skills of that labor force needs to be adapted over time as well, which will ultimately lead to a higher skilled workforce in future, and maybe better paying jobs in the future as well, which will ultimately further enhance productivity over time, because the more skilled your labor is, the more productive it will be, and the more productive your labor is, the more productive your business efficiency gets, or the more productive your business gets, which contributes to long-term growth across the economy, right? So these are all the long-term advantages that you should be mentioning. So yes, we agree that there is a short-term opportunity cost of producing capital goods, which is foregone consumer goods. But in the long run, in the long term, the opportunity cost of not investing in capital goods will be very much clear and significant. The economy is risking, if you do not invest in capital goods, then what you students will say is that you will say that your economy is actually risking falling behind in technological advancement. It is risking falling behind in productivity. It is risking falling behind in your overall competitiveness of the goods and services, and the overall competitiveness of the entire economy on a global level, right? So failing to invest in capital goods can result in lower future growth. It can lead to lower and less innovation, and in fact it will lead to an economy that will it will ultimately create an economy. If you do not invest in capital goods right now, then in the future it will create an economy that will not be able to meet the rising demands of its population, right? Because let's say your existing capital will break down, and it will not be able to produce consumer goods to satisfy future population demands. Therefore, yes, so the good way to write is that you'll say that, okay, fine, yes, we agree that yes, there is a short-term trade-off. While you'll say that while there's a short-term trade-off, where you're sacrificing immediate consumption. So yes, there's a short-term trade-off where you're sacrificing immediate consumption, and this is actually a short-term trade-off, right? This is a short-term trade-off where you're sacrificing immediate consumption, but you'll say that the long-term opportunity cost of avoiding capital investment will be very high, the long-term opportunity cost of avoiding this capital investment will be, very significant, and it will result in a potentially weaker economy in the future. Right now, guys, the last thing that I want to discuss before I end this video is that when we are talking that we are investing more in capital goods, basically investing in capital goods is investment that we talk about. So basically, and there are two types of investment that we need to differentiate. That is, one is gross investment, right, and the other is net investment. So basically, when you use the word gross investment, this is referring to the total amount of investment that is spent on a new capital. That is your total investment that is spent on it, has total amount that is total amount that the economy spends on new capital, basically, right? But the thing is that this new capital includes the spending done as replacement investment, as in this figure includes an estimate for the value of the capital depreciation, which means that some of the investment is replacement investment, since some investment is needed each year just to replace the technologically obsolete or worn out plant and machinery, right? But when you deduct the replacement investment or you deduct capital depreciation, which is known as replacement investment, from gross investment, you arrive at net investment. So net investment is basically your gross investment, right, minus your capital depreciation, which capital depreciation is also known as your replacement investment, basically, right? Replacement investment. Anyways, so if so when you're talking about that in the long term, your production possibility curve shifts outwards and your productive capacity enhances and your productive potential is increasing, it only happens when your net investment is positive, which means that your gross investment is higher than your replacement investment. So if your gross investment is higher than your capital depreciation or replacement investment, it means that your net investment is positive. And net investment positive means that the business is investing in new capital on the acquisition of new plant and machinery, equipment, infrastructure. That's what we're talking. That is what enhances productive capacity. The replacement investment will not enhance productive capacity. It will just maintain the existing capacity, right? It will just maintain the current output. So if the gross investment is higher than depreciation, then net investment will be positive. This means that your business will have the economy will have a higher productive capacity, and hence can meet, increasing demand for goods and services in the future. So when you're talking about investing more in capital goods, which is causing an outward shift in PPC, we're actually talking about the investment in new plant and machinery and new capital. That is what we are referring to. Okay guys, so I hope you understood this video and enjoyed it as well. If you haven't subscribed to my channel, please do subscribe, and I'll see you all in the next video. Until then, take care.